Thanks for tuning in to Talking Point. I'm your host Niraj Shah. Penultimate day to the exit polls, 3 days. Yes, 3 days to the election verdict as well. I was counting the number of trading days. So it's a very exciting time to be an Indian market watcher. I don't know if it's as exciting a time to be an Indian market investor, especially if you are a very active investor. But we have somebody who probably invests for the long term, Krishna Sanghavi, CIO-Equities, Mahindra Manulife Investment Johnson right now on the show. Krishna, good having you in our studios. Thanks for taking the time out. I hope all is well. And do you reckon that the excitement, at least to us, is palpable? Do you reckon that there is enough case for this excitement, or would you believe that longer term trends are much better to focus on?
Yeah, sure, Niraj. Thanks for having me. And no, I guess anybody who's been in this market for last 20 odd years or maybe 25 years, I think the excitement is palpable, and it's possibly, we've been born through it, having seen 2004 and 2009, extreme events of a circuit down and circuit up. So if you've gone through that, obviously the election actually becomes, something which is more of excitement rather than something which is relevant from a time perspective. So time perspective is very simple. 2004, Nifty would have been wherever it was, and today we are at what, nearly 7x, 8x of Nifty. Market cap creation would have been far more. So I think that economic journey is honestly far more critical on a longer term time frame. But yeah, we all need some, some data point to get interested on a shorter end cycle, and maybe election gives us this opportunity maybe every 5 years in India. So if you go to 2004, honestly, we had a circuit down, right? And 2009 circuit up, and those two memories can never go away from an average memory recall is always going to be there. Okay, that election can create those extreme events. Yeah. And that's where, we are for last, 40 days been going through this.
Interestingly, as you pointed out, that the last 40 days, while there have been a lot of ebbs and flows, per se, point to point, it's not been a very major market moving period. It has been a market moving period, but point to point, not so much.
Yeah, you're right. I mean, you look at, let's say, 18th April as a so-called relevant date, which means that 19th April Indian election started. And for all this discussion about election and opinion poll, etc., we are what, around 2% up from the day of 18th April, and maybe global markets are up nearly 4%. I'm using S&P 500 as a so-called most appropriate benchmark. Now, when you look at it this way, yeah, Indian markets are connected to the global markets as much as Indian economy is connected to global economy. The relevance can change at various points of time, but the macro picture of India being a subset of global economy and Indian markets being a subset of global risk appetite, global sentiments, I think that can't go away, irrespective of elections.
Point well noted. Okay. Do you believe, one more question here, do you believe that I mean, again, since we have to use benchmarks, I'm using the tally that the incumbent party got in 2019 as the benchmark, purely the incumbent party. And do you believe a 10% vote count, either direction, is a market moving event?
Yeah, honestly speaking, it's tough to predict when there are 97 crore people, likely to vote, as in eligible to vote, and we don't even know how many actually ends up voting, right?
Yeah.
That's why the debate about voter turnout. So it's just not really something relevant as far as,
But will it move the market, Krishna, you reckon? For the short term, do you think that 10% swing either way could actually either derate the market temporarily or give a further upswing to the market as well?
It's really tough. So if as I said, to go back to history, 2004, 2009 kind of examples, you have history. And is the same history you use for a 20-year cycle or a 10-year cycle on investment front? Answer is no.
Sure, okay.
So, India's economic journey and maybe the market acceptance and, wealth creation part, honestly, is far bigger of potential than worrying about something, as you said clearly, just a 3-day more event,
Got
maybe, somewhere on 4th June by 12 noon or so, whatever, time, broadly, all these debates might be addressed,
will most certainly be addressed. Okay, let's try and talk about more predictable things. Have you guys been sitting on cash to deploy at lower levels because of the valuation risk and the event risk, of course, that comes in, but since the last 1-2 months or whatever it is, have you been doing that?
So I think broadly, over time, we realize that equity as an asset class is going to create value. From asset allocation perspective, either the wealth manager or the investor himself have done their own bit of asset allocation. So my guess is, maximum cash of 3-5% range is is in a way the upper limit based on the type of the fund. So if it's a small cap, I'll be more towards maybe 5-6%. If it's a large cap oriented, will be much lesser. The idea is to generate alpha through stock selection, etc. So I have average cash. Even if I go back to maybe last 4-year history, and unfortunately, we had this period of COVID, which perhaps was a very exceptional event. And I can say that even in that COVID times, we never went to double-digit, cash in the fund, where for the kind of volatility, uncertainty we saw in March 2020. So yeah, I mean, cash of 3-5% somewhere is there, but there are always enough number of stocks which call it either maybe defensive, maybe some stocks which are relatively different kind of behavior on a event, and slightly more longer term implication on anyway Indian economy. So not so much of cash.
Not so much of cash. Okay, that's one debate settled. The other one is the verdict on earnings growth and the valuations. Now, where are you on that argument, having seen what FY24 has thrown up? I mean, we've almost completed the earnings season, and what your estimates might be for FY25.
Yeah, sure. So I think let's look at broad consensus market rather than our own, because
Sure,
there's
do
a
that.
bigger picture available there. Indian economy, if you look at it, we've grown at what around 11% on nominal last year. So economy wise, if you correlate, the earnings are around, let's say, 12-15% range. Maybe the bigger share of earning last year actually has been banks. The lenders have earned a slightly more disproportionate share of profit pool because of interest rate regime. I think that's one thing which need to be aware, because that's something which might just go away next year in FY25, because the base is so strong that incremental growth cannot come in. Otherwise, I think fair to assume 12-15% earning growth for FY25, which is relatively more in line with the long-term trend. But the other macro picture is we need some sort of a volume growth. Lot of money has been made through margin front in FY24, and we do need some volume growth, and hopefully that's something to watch out for in FY25, whether which set of market, which set of sectors can actually deliver the volume growth for economy. But otherwise, yeah, margin-led gains are broadly part of the base. We can't have a surprise there in FY25.
You mentioned that the longer term trends would remain independent of what happens in the short term gyration, but earnings growth, government policies, etc., all become important. In that sense, would therefore the budget be a big trigger, assuming there is policy continuity, or even otherwise? Would the budget be a big trigger, or not really, because it's the first budget of the next 5-year term?
You're right. I think that statement, first budget of the 5-year term is actually very interesting, because government is going to lay down their own priorities, their own thoughts on what they intend to do. And to my mind, yes, budget is going to be an event which can help us from an economy side. Because as you said, the 4th June event is possibly a single day event, but what is spoken in the budget is more or less the blueprint for what the government intends to do for next 5 year, and that's where go back to it. Last 20 years odd, Indian economy has been a nominal GDP growth rate of 12% odd. I think that number has not really changed, right? And 20 years is a long period, enough elections in between, etc. So to that extent, I think that macroeconomic connect for how Indian economy is responding to the global markets, global economy in terms of getting our own share of exports to grow GDP is intact, and our own relevance to global markets in terms of the growth economy, which is getting its own rank growth. So we would have been 16th ranked economy or so 20 years back. We are now 5th. So that track is intact, and that's what is a big picture, honestly, for all Indian market investors.
Got it. In terms of either the budget or the earnings data, what sectors or what themes have stood out for you, Krishna, or will stand out for you? Yeah.
So what's what we observed really around a year back is that assuming in all this global piece of China plus one is going to play out, whatever government of India policies on PLI and Atmanirbhar Bharat is going to play out. What we realize is that you really need some sort of comfort on the core economic sectors to be available to India when Indian economy needs. And the idea is that somewhere in FY27, FY28, we might just not have enough amount of either power availability or a steel or aluminum capacity or a refining capacity, because let's face it, in this entire debate of Atmanirbhar, PLI, China plus one, what we are doing is going to say manufacturing replication. So what some factory in Germany is using as a power from German grid, or Chinese labor is being paid off in a Chinese factory, or fuel being used in some other country, we intend to get it done in India. So our need for that steel or that power supply or that petrol diesel for logistics is going to increase. And if you follow this, luckily these industries have a 3-5 year gestation period. So it's slightly easier to predict a demand supply mismatch which may happen in 27, 28. And in fact, the power policy document last year was eye-opener, right? That we need so much of power growth. And like recently, what we followed recently, there's I think Vietnam is asking, the iPhone manufacturers to reduce the power consumption, which means, some of this activity when they're outsourced away from China into any other geography, any other country, that country is going to have a nice growth pattern available for those industries. And unless you are investing now to create that power plant or a steel plant 4 years down the line or 5 years down the line for consumption, so that's a core economy need is something, which honestly looks very exciting, pretty attractive. I agree, valuation can have a role to play, but somewhere that's something, a nice sweet spot. Manufacturing is a core theme, which is PLI, which is Atmanirbhar Bharat. You got a nice piece where India actually has a population, a demography of 140 odd crore people. So consumption is, market is available. Policies are in place to either do import substitution, which means something which we are already consuming just needs to be replaced by a Indian manufacturer, or China plus one kind of potential opportunity either from a global side or from a government of India incentive structure wise, where some Indian companies can manufacture for the world. So I think that manufacturing piece is somewhere very well integrated to this entire thought process on what can play out for India in next 3-5 years journey for this.
Interesting. Well, speaking of all that's happening around this, be it the PLI schemes, be it manufacturing, be it earnings, I think it's important to also take stock of some of the things that Krishna mentioned in light of the recent releases as well. I have my colleague Puneet who is standing by to talk about Cummins, because I would want a view on what could happen to capex slash engine slash the export growth out of India. Because Puneet, I did hear Aswath when he spoke to us speak about exports bottoming out. Now, I wonder if the con call and the subsequent brokerage commentary is also capturing that, because the stock price clearly isn't.
Well, definitely the conference call did capture that, and as you rightly said, they did mention on exports being a little soft for the first quarter, but then coming back on for the geographies. But this year will be a key watch out for the exports. Now, let's see what the brokerages also have to say, because they have upgraded their target prices this morning. So, Citi has maintained a buy with a target price of roughly 4,384. And this is up from roughly 3,500 odd, which they had previously. So, and it's giving an upside from 22% from the current levels as well. Now, they have said that domestic demand has been one of the key strong points for the Cummins in this quarter and the year as well, while exports have been slightly softer, as you mentioned as well. Data centers, now this is one of the key sectors that the management spoke about, and also the brokerages are affirming, where it's roughly 10% of their current power gen revenues, up from just 1% a couple of years ago. So, and they expect the next 5 years where this business could even double from these particular levels. Royalty, which is a one key thing which MNCs, which we look at for MNCs now, royalty is just at 1.7% for this particular quarter and year versus 3% last year. And the positive thing is that the company is expecting to maintain the same level going forward as well. Citi also says that management's guidance of 2 times of revenue growth compared to the GDP for the next couple of years is a very hearty and positive, or roughly 12 to 16% expected from here. And they've increased their estimates by roughly 17% and 24% for the next couple of years. Motilal also had a buy with a target price of roughly 4,100, which is a 14% upside from the current levels. And they said that there were 3 key positives from the results: long-term demand being strong for power gen, readiness for new emission norm, which come in from the 1st of July of 2024, and ability to sustain margins. And Nomura has upgraded it, maintained the neutral stance, but they've upgraded the target price to 3,400 up from 3,040 rupees. So overall, most brokerages have upgraded their estimates as well as target prices and remain strong on Cummins going forward. Back to you.
Got it. Thanks for that, Puneet. Now, this is a Cummins specific thing, but Krishna, come in on this argument around how Indian exports, I mean, we were speaking to Nomura day before yesterday, And Sonal Verma was saying that there's a natural lay of land wherein exports from India, Vietnam, others will go up because China is naturally vacating some of the things as Japan had in succession to Hong Kong, Singapore, and then those countries had in succession to China. So China is vacating that, India, Vietnam, etc. will naturally benefit. And here are companies talking about how exports are bottoming out. Do you like the export-oriented theme?
Yeah, clearly, exports-oriented theme, especially these are all manufacturing related, right?
Exactly.
So if you look at macro again, India's market share in global manufacturing or global export share is quite low vis-a-vis what maybe China is. Even if you're able to get little bit out of that, it's going to be a material growth rate for India. And to that extent, yes. Let's also look at it, the globally also, let's say US, for example, they're doing their own share of their own version of PLI, which means they also want to manufacture something in US vis-a-vis what they would have outsourced in the past. So there is a global capex in place, whether it's something like a Cummins kind of example, or if you look at power sector where renewable energy is creating its own share of demand for infrastructure there on power sector front. I think that piece is intact. Any Indian company which is able to have this quality controls in place to able to supply to a global customer, I think they're going to have a reasonably good
There are enough companies doing that, you think, in India? Enough companies are doing that now?
Yeah, there are companies who are capable of reaching those quality controls which require. Maybe scale can be a challenge because the requirement vis-a-vis what those companies are today might be very large. That's opportunity actually of little bit of a capex which is required to achieve those bigger scales. But capability wise, we believe quite a few companies are available.
Got it. Which explains, I believe, you're launching some manufacturing theme as well. So you seem to be very constructive.
Yeah, we actually launching manufacturing fund. In fact, we launched today itself.
Oh, you're launching today itself. Okay, all the best for that. All the best for that. So the last two answers kind of explain why you're so constructive on that theme as well.
Yeah, partly yes. At the same time, when we're launching a fund, obviously one is aware of what's the global, macro, as well as what Indian government, etc. is doing, and maybe Indian corporates' ability to respond. So yeah, opportunity is there. And in fact, if I look at our own manufacturing fund, obviously one is the global opportunity. Other is as I mentioned earlier, 140 crore people. We want to consume everything, whether it's automobile, whether it's FMCG, whether it's pharma. So it's not only the global piece. It's going to be far more inclusive in terms of ability to manufacture any product, either import substitution, which is actually very large, right? Our non-oil, non-gold imports are pretty large, and if something can be done to cater to that demand itself, it's going to add nice to India's GDP as well as to those corporates.
No, certainly. The last few days, technology and IT in particular has seen a bit of a pullback as well. Are these global concerns, rate concerns that are leading to this, or do you see something specific in Indian IT which could be slightly bit of a dampener?
I think the bigger piece is the worry on the US economy and what can lead to some sort of slowdown in the clients of these companies. I think that's something far bigger on the market mind rather than too much about issues. Yeah, the debate about what AI can do to some sort of jobs in IT service industry can be there, but it's slightly early, honestly, for anybody to have a full-fledged view on what actually can play out. Right, too much opinions right now, but I think the bigger piece right now is the worry about some recession or some slowdown in US economy, which can impact the business in the near term for these companies.
Got it. My final question, and again actually making a segue back to manufacturing. If you are, I mean, the standout for the last 6 months have been the PSU names linked to defense, yes, but even otherwise. They have outperformed the benchmarks by a country mile, if you will. Valuations have moved up, but they're delivering on results. How does an investor like you view those shipbuilders stroke defense names, particularly in the PSU space? They've never enjoyed these valuations. They're now really enjoying them, and they're delivering on the numbers too. What do you do here?
Yeah, so again, for me, PSU in a way fit a little bit into the core economy theme. If you observe, all those core economy sectors has a nice presence of some PSU company in steel, power, aluminum, refining, etc. More specific to the defense, kind of opportunity, I think that's a new opportunity which came up in India just 2 years back or so. Moment we went for this Atmanirbhar Bharat, as a thought process, as a policy. So again, same thing. I think the opportunity is huge, and yeah, valuation is something always going to be an open end across the market. It's not only for defense. I think any industry which has a slightly longer runway, one can worry about valuation. Is slightly debatable how much to worry about, because you never know the kind of growth rates these companies enjoy. But yeah, one has to be cognizant that this is a replacement demand. So to an extent, it's slightly better on that front, that what India already is spending abroad is possibly going to be replaced by India spending on its own purchase.
So we have 10 seconds. You seem to be okay with the valuations. You're not negative on these stocks.
On defense specifically,
Yes.
I think they
Yes,
are
you
pricing slightly longer term time frame. So investor wise, yeah, you need to be aware of a longer term rather than the extreme short term. The evaluations are rich.
Got it. Okay. Much appreciate this, Krishna. Great having you. Thanks for taking the time out and being with us here today.
Yeah, thanks.
And viewers, thanks for tuning into this edition of The Talking Point.